Imagine waking up tomorrow and finding $10,000 sitting in your bank account. You feel good. You've done what you're supposed to do. You didn't blow it on a car. You didn't spend it on vacations. You saved it. But here's the uncomfortable part. If that $10,000 is sitting in a typical savings account, earning around 1%, you're making roughly $100 a year. Now imagine putting that same $10,000 to work for decades. Suddenly, we're not talking about $100. We're talking about potentially tens of thousands of dollars in growth. And that's where millions of people get stuck. They've learned how to save money, but nobody taught them what to do after they've saved it. They've heard about stocks, ETFs, index funds, and compound growth. But then they open a brokerage account, see a screen full of numbers, hear that the market could crash, and think, maybe I'll wait until I understand this better. And that decision can quietly cost them years of compounding. Because here's the biggest misconception about investing. You don't need to become an expert before you start. You need a simple system. I'm Mike, and if you've got money sitting in savings, but you're not sure how to turn it into long-term wealth, you're in the right place. Subscribe to the channel because we're going to make money and investing simple, practical, and actually useful. Today, I'm going to show you the simple path from saving money to investing money without turning your finances into a casino. Let's start with the first step. Step 1. Build your emergency fund. Before we talk about stocks, before index funds, before compound growth, there's something much more important: your financial safety net. Imagine you invest $20,000 today. 3 months later, you lose your job. And at exactly the same time, the stock market falls 20%. You suddenly need cash. What happens? You sell your investments. But you're selling after they've fallen.
Now, a temporary market decline has become a permanent loss. That's why your first priority isn't maximizing investment returns. It's creating enough financial breathing room that you don't have to sell your investments at the worst possible moment. For many people, that means building roughly 3 to 6 months of essential living expenses in accessible cash. Your emergency fund isn't there to make you rich. It's there to protect the money that you're trying to make rich. Think of it as your financial shock absorber. When life hits you, your investments don't have to. Step 2. Decide what money is actually investable. Now comes a distinction that a lot of beginners miss. Not every dollar you have should be invested. The question isn't simply, should I save or invest? The better question is, when will I need this money? If you're going to need the money soon, for rent, an emergency, a car, a house down payment, or another major expense, you generally don't want that money exposed to the same market risk as money you're investing for decades. But if you don't need that money for many years, that's where investing can make more sense. So instead of thinking about your money as one giant pile, think about it based on time horizon. Money you need soon has one job: stay available and relatively stable. Money you won't need for years has a different job: grow. And this distinction can make investing feel much less scary, because you're no longer asking, should I invest all my money? You're asking, which money can I actually afford to leave invested? Step 3. Stop looking for the perfect stock. Now we get to the part everyone wants to talk about. What should you buy? Apple? Nvidia? Tesla? Amazon? The next big AI company? But here's the problem. If your entire financial future depends on choosing the right company, you're making investing much harder than it needs to be. Instead, many long-term investors use something much simpler: broad index funds. An index fund can give you exposure to hundreds or even thousands of companies in one investment. Instead of asking, which company will win, you're essentially saying, I want to participate in the growth of the market as a whole. That's diversification. And diversification matters because you don't know which company will dominate the next decade. Nobody does. The company everyone thinks is unstoppable today could be struggling 5 years from now. But a diversified portfolio doesn't require you to predict the winner. You're spreading your risk across many businesses.
That's one reason low-cost index funds have become such a popular approach for long-term investors. It's not exciting, and that's exactly the point. Step 4. Don't wait for the perfect time. Now comes one of the biggest psychological traps. You decide you're ready to invest, but then you start waiting. I'll invest after the next market crash. I'll wait until interest rates come down. I'll wait until the economy looks better. I'll wait until stocks become cheaper. And suddenly, 6 months becomes a year. A year becomes 3 years. And you're still waiting. Here's the problem. Nobody knows exactly when the perfect buying opportunity will arrive. Markets can fall. Markets can rise. Markets can remain expensive longer than you expect. And sometimes the market crashes, only to recover before the person waiting for the crash ever buys. That's why many long-term investors don't try to perfectly time the market. They build a process. They invest consistently, month after month, year after year. The goal isn't to predict tomorrow. The goal is to make sure you're still invested when tomorrow becomes 20 years from now. Step 5. Start smaller than you think. Another reason people don't invest? They think they need a huge amount of money. They don't. You can start with $50, $100, $300.
The goal at the beginning isn't to become rich overnight. It's to build the habit. Because imagine you invest $300 every month. That's $3,600 a year. Over 25 years, you'd personally contribute $90,000. Now, suppose those investments averaged 8% annually over that period. You could end up with roughly $285,000. You contributed $90,000. The remaining roughly $195,000 comes from investment growth. That's the part people underestimate. At the beginning, you're doing most of the work. You're putting money in. But eventually, your money starts doing more of the work. And that is the power of compounding.
Step 6. Understand why investing feels scary. But here's the part nobody can explain with a spreadsheet. Investing is emotional. You can understand everything we've talked about. You can know you're investing for 25 years. You can know that market crashes are normal. Then, one morning, you open your brokerage account, and you're down $3,000. Suddenly, your long-term strategy doesn't feel so logical. You start thinking, maybe I should sell. Maybe the market is going lower. Maybe I'll buy back in later. And this is where many investors make their biggest mistake. They sell because they're scared, and then wait for things to feel safe again before buying. But by the time things feel safe, the market may already have recovered. The market doesn't just test your financial knowledge, it tests your behavior. And that's why investing success is often less about predicting the market and more about controlling yourself.
Step 7. Don't turn investing into gambling. Now, imagine you start with a simple index fund. Everything is going well. Then you see someone online who made 300% on a stock. So you buy that stock. Then someone else makes money trading options. You try options. Then there's crypto. Then meme stocks. Then leveraged ETFs. And suddenly, your investment portfolio looks like a collection of bets. There's nothing inherently wrong with learning about different investments, but understand the difference between investing and speculating. Investing is about owning assets with a long-term plan. Speculation is often about trying to predict what happens next. One can build wealth steadily. The other can make you feel like a genius right before the market reminds you that you're not. You don't need your portfolio to be exciting. You need it to work. Step 8. Automate everything. Now, here's the simplest way to make investing easier. Stop making it a monthly decision. Automate it. Your paycheck arrives. A predetermined amount automatically goes toward your investments. You don't have to ask, should I invest this month? You don't have to wait for the market to fall. You don't have to wait until you feel confident. The money simply moves. And that matters because motivation is unreliable. Some months you'll feel rich. Some months you'll feel broke. Some months the market will be soaring. Other months it'll be falling. But your system keeps going. That's the advantage of automation. You remove yourself from the decision. The biggest insight. And this is probably the most important thing I want you to take away. The goal of investing isn't to find one incredible stock. It's not to turn $1,000 into $10,000 in 6 months. And it's definitely not to become a full-time trader. The real goal is much simpler. Build a system where your money keeps working when you're not. Your salary pays you for the work you do. But your investments can potentially generate returns simply because you own
productive assets. And over decades, that difference can become enormous. Think about 2 people. They earn the same salary. They live in the same city. They have similar expenses. But one person saves whatever is left at the end of the month. The other automatically invests a portion of their income before they have a chance to spend it. 10 years later, they could look financially similar. 20 years later, the difference can become enormous. Not because one person discovered a secret stock, not because one person timed the market perfectly, but because one person gave their money more time to compound. The simple investing roadmap. So if you're starting from zero, here's the entire process. First, build an emergency fund. Second, decide which money you actually need to keep safe based on when you'll need it. Third, separate that short-term money from money you're investing for long-term goals. Fourth, decide what you're investing for and how long you can leave the money invested. Fifth, choose diversified investments that match your goals and risk tolerance. Sixth, start with an amount you can consistently afford. Seventh, automate your contributions. And finally, stay invested and give compounding time to work. That's the system. You don't need 5 monitors. You don't need to watch the stock market all day. You don't need to predict the next recession. You don't need to find the next Nvidia. You need a plan and the discipline to follow it.
Because the hardest part of investing isn't finding the perfect investment. It's staying invested long enough for an ordinary strategy to become extraordinary. So don't focus on becoming the perfect investor. Build a simple system. Start with what you can. Keep learning. And give your money time. Because when it comes to building wealth, time isn't just something you have. Time is one of your biggest assets.